So we've gotten a couple questions on the volatility conversation that we had on Monday. We're going to address a couple of those. And this being open mic, I want to be open to your questions. So we ought to take a look at some of the upcoming earnings, and we will talk about some of those too today on Open Interest. Well, hello there, everybody. Welcome to Open Mic. I'm Mike Coe, and on Monday, for those of you who tuned in for that, we had a somewhat deeper conversation about volatility. We touched on the VIX, its calculation methodology. If you saw that, I'm going to be repeating myself a little bit here, but the VIX index, what we refer to as the cash index, which isn't really something that you can trade, is basically just an interpolated strip of 30-day SPX options prices. It gives us a sense in real time of what the SPX options market's expectations are for volatility over the next 30 days. And it's always looking 30 days out. So today's VIX is different than tomorrow's and Friday's and next Monday's and so on. One of the observations I had made was that it was highly unusual for the VIX to spike violently, as it did on August 5th, and for volatility in the S&P to be below average thereafter, which essentially is what last Friday's closing VIX was implying. And so I took a look at the history and looked for all the circumstances where we saw a VIX close above 35. In fact, it closed at over 38 on August 5th, and it hit over 50 intraday. I think even in the pre-market, it may have gone over 60, although that's a more illiquid market, so it's not, quite the same thing. So I like to look at SPX options prices during their regular trading hours. And what I had proposed was that one could buy a strangle. So buy a 30 delta call and a 30 delta put, perhaps out to say October or so, and then hedge that delta neutral, even just once a day. So at the end of every day, you calculate what your net deltas are, and you adjust your underlying stock positions accordingly. And at least one person who viewed has subsequently reached out to me and has actually started to do that trade. And if I heard correctly, they were slightly profitable, which is good. I think they had traded one SPY strangle and up about 500 some odd bucks or so in the day since, but had some questions about how we do that calculation. So just to quickly go over this, and I think what I'm going to do here is I'll share my Bloomberg screen, and I realize, as I've often said, that this looks a little bit like the Matrix. There's a lot of numbers on here, but I'm going to try to strip this down a little bit. So the screen you're looking at right now, if you are seeing one, is, and you are, okay, this is just an options montage. So an options montage just gives us all of the expirations. In this case, the calls are on the left, the puts are on the right. And what we're going to do here is I'm just going to go ahead and look out to October regular way expiration, which is October 18th. And we're going to expand the number of strikes that we can see. I'm going to expand that. Okay. And what I had suggested was a 30 delta put and a 30 delta call. So when you put that trade on, it's delta neutral to begin with. Now, the specifics here aren't super important, but let's just say that you're looking at the 545 strike. So I have to actually center it around that, and we're going to see what that delta is. So the SPY 545 puts, those are 29 delta, almost 30, okay. And then maybe we'll look at the 575 calls, see what those are. Those are 35 delta. Let me bump it up here, and we'll say the 579s. Also 29 delta. So if you bought one of those puts, the 545 puts, and you bought the 579 calls, you're buying one put that has a negative 29 delta, and it will reflect on here as 0.29, but every options contract generally has 100 shares, so you multiply the share quantity times the delta. You get 29 short deltas. The calls are 29 long deltas, so you'd be buying those. Those two offset, no hedging necessary. Okay, so if you buy one of these and the market rises as it did today, what will happen is that the delta of your long put will go down and the delta of your long call will go up. So these things will no longer offset. So let's just say, for the sake of argument, it goes up. And actually we can, we could do an exact calculation, but that's not important for this conversation. So it goes up a couple of bucks and the put delta is now, let's say, 25. And the call delta has gone up to, say, 35. So short 25, long 35, add them together, you get long 10. So what that means is if you owned that strangle, at the end of the day, you would enter a market on close order to sell 10 shares of SPY. And then overnight, you would be going home delta neutral. On the next day, let's say, for the sake of argument, that the stock then reverts back to where it had been previously. So it goes down a couple of bucks, and they both go back to 29 delta. Well, so the options position is now delta neutral, but you're still carrying that additional 10 shares that you had traded the previous day. So you were short 10 there. Now, to get delta neutral once again, you would buy those back. And in effect, that's how you're realizing the changes in volatility, right? Because you will have sold 10 shares, up a couple of bucks, you will have covered those down a couple of bucks, and all of that time, or at least at the end of every day, you're trying to true up those deltas and hedge them effectively, delta neutral. Okay, so I'm hoping that answers the question that had been posed. I actually don't know if it ended up in the chat, in which case I can actually share it. Let me see. Here, I'm going to send that. So Brad Holt said, on the Delta Hedge from Monday's discussion yesterday, I bought 7 shares with the SPY down. Then today I sold 6 as the price went up. Does that sound right? And yes, that sounds exactly right. If you put this on delta neutral and the very next trading day, the market falls, you are what we call long gamma. So that means that your deltas go down as the market goes down. We like that. And then you would buy stock to get delta neutral again, and your deltas will rise naturally as the market goes up. We like that too. And then you sell them. And the whole idea here is that the profits you realize transacting by buying the stock when it dips and selling it when it rips should be sufficient, if you bought the strangle at a good price, to pay for the decay of that options package, and hopefully and then some. Right? So that's the whole objective. There are other ways that from one day to the next you might actually see profits other than just trading the stock, though, of course. If implied volatility rises, the value of those options will go up. And that can have a small impact on your deltas as well. And similarly, if it fell, then the value of the options package would drop, all else equal. So you have really 3 drivers, if we will, on your P&L. One is just the day-to-day decay of the options package, the changes in implied volatility affecting the value of those options, and your delta hedging, right? And it's one of the reasons why I don't propose these types of strategies very often to get long, because in general, for the indices and for their related products like IWM, Diamond, SPY, the ETFs, there's usually a volatility risk premium, which means that they are typically a little bit overpriced. I mean, overpriced isn't arguably the right word. Options are a form of insurance. You expect to pay something for it and maybe a little bit extra. So the person who's underwriting it is also expecting to profit, and they aren't generally going to offer it at unusual levels. My point Monday was, though, that generally speaking, after you've seen a big spike in the VIX, oftentimes there's essentially aftershocks in the market, right? So that just means that realized volatility would be higher. That would be supportive of owning options. That combined with the fact that options premiums were quite low, indicated by the VIX being at 14.7, which is below its 30 plus year historical multiple, a multiple number of about 18.7, 18.8, something like that. So yeah, and actually, so Tucker D Dog is asking if you bought the strangle at a good price. What defined a good price? So buying it at a good price is buying it at an implied volatility that is lower than what we believe the market is actually going to experience between now and the expiration date of that options package. So if my implied volatility is 15, but every single time prior that we had the VIX spike to 35 plus, the realized volatility number we got was something closer to 20 or 22, then that's what we call a good price. We have reason to believe that you could experience market volatility that is above what the market is implying, which brings us to another natural question, which is, well, why then are options prices so cheap? I mean, isn't this something that everybody can see? And that would be a very fair question and observation. So there's a couple things, we're only speculating about what motivates people to sell volatility at certain levels and buy it at others. But one of the potential reasons that we would see the volatility first spike very quickly and then fall as rapidly as it did comes from basically two different volatility-related trading strategies. The first are exchange-traded products, ETPs, that focus on being short vol. So those products, if they are short vol and vol starts rising, they may be compelled to purchase it back. We have seen this in the past. In fact, Volmageddon in 2018, January of 2018. Was it January 2018? It might have been the first week of February. We had an ETP that blew up. It was a short vol product, and it basically started to come undone. They had to cover, and that created huge disruption in volatility prices. So that's a reason why you could have a big spike. The reason that you could have some natural selling on the index side in particular is that a very popular trade amongst professional options traders is something called the dispersion trade. I think I alluded to this on Monday also. This was a trade we were very active in. It's a form of statistical volatility arbitrage in which usually market makers, or what we now more frequently refer to as high frequency traders, we're talking about the Citadels, Susquehannas, I don't know whether my former employer Bluefin is doing this or not. The company I worked for got acquired by Knight Capital Markets, which some may know blew up a few years after that acquisition. But effectively, the trade is this. You sell options on the index, and you buy it on all of the single stocks. And if you're a market maker in these products, this is something that is relatively easy to affect. That is to say, it's a trade that's relatively easy to put on because you're already out there making markets and all of these things. And provided that you're capturing decent edge on the single stocks that you own relative to the index that you sell, that's one way to profit. And as stocks returns are dispersed, so one goes up, the other goes down, you can make money on your long options position on the one that went up, you can make money on your long options position on the one that went down, but those effects actually offset one another within the index. And it's one of the reasons why we would often say that if you are long dispersion, that is to say long options on all the single stocks and shorted on an index, you might also say that you are short correlation, right? Because if correlation rises, then your basket of stocks and the index are going to behave more like each other. And so then the trade doesn't set up very well. And so that also creates a vol of vol when you have these disruptive events, because you have a very crowded trade that people may need to cover. You have another crowded trade in the form of ETPs that short volatility, and they may also need to cover. And just a quick point on that, why do they need to cover? Why do they need to do anything? Can't they just sit still? Well, the issue that you have sometimes with ETPs is that they may have some leverage embedded in their strategy. If you are a volatility trader, ultimately you're on the hook for whatever you do. You have a customer portfolio margin account. You have, let's say, $150,000 in your account, and that may be suitable to put a position on, but you may get a margin call. That is to say that your broker says, hey, listen, your margin's is insufficient to meet what we require for these positions. ETPs can't do that, because if somebody buys an ETP that shorts volatility, the most they can lose, because it trades like an equity, is what they put in. From the fund manager's perspective, what that means is that they must then manage the portfolio dynamically to adjust their risk accordingly. Something that in most other circumstances wouldn't be necessary, although it can be, depending on the degree of leverage. So I think that's part of what's going on. And then, of course, you have other rumors about things like yen carry trades being put on, taken off, etc. All of those things are potential dynamics. So, and you can go back and watch Mondays if you want a little bit more clarity on that. I think we've sort of described what the strategy is. So PC says, in your VIX example, suppose you want to hedge with QQQ with a 30 delta put 2 months out. If VIX explodes, cash out. Triple Q, November 15, 460 puts, 4940. Okay, so yeah, let's talk about this also, because I think this is an interesting point. I'm not sure, not 100% sure this is what PC is referring to here. But most of us have net long equity exposure, right? So you own stocks in your 401k, in your IRA, in your PA. Unless you're Jim Chanos or something, chances are you're net long. We almost all of us are net long. So it is true to say that you could take your existing portfolio and say buy a 30 delta put on the Qs and still stay net long. So for the sake of argument, let's say that you had the equivalent of 500 Qs. So Qs are almost a $500 instrument, so that's $250,000 portfolio. Let's just say that the Qs are representative of your long equity position. And you said, well, I expect a volatility spike. And consistent with that, I'm also expecting the market to fall. So rather than just trading vol, buying a downside put and an upside call like I suggested on Monday, you said, well, what if I just bought the put, right? So I've got 500 shares, so I buy 5 November, and which ones did you say? Forgive me, 460s, okay. So you buy 5 460 puts, which are indeed, they're 939, 947 or so as of today's closing price, about 28 delta, according to Bloomberg anyway. So you could buy 5 of those and just look to trade those around an anticipated volatility event. And that's going to work fine. So what's going to happen to your position? So you had a $250,000 net long. You just bought 5 of these. They're 30 delta apiece. So that's 150 shares equivalent of short deltas now. So effectively, your portfolio is now going to behave not as if you are long $500,000 worth of NASDAQ 100, but only 70% of that, about 350,000. Actually, even just slightly less, because Qs aren't actually $500, they're about 485. And so a couple things you could do there. One thing you could do is you could just wait for a volatility spike, or you could wait for the market to fall, close your puts for a profit, or alternatively, you could lean into the puts by buying those deltas back. So you could, buy those Qs, Q puts, and if the market dips, say, you know what, I kind of feel like this drawdown is about as much as we're going to experience, but I don't know that volatility is completely over. And you could simply buy some of those deltas back. So buy 150 shares of Qs, and you're going to get back to the delta position that you had before you did any of the options trading. You'll be back to $500,000 net long, like that. Okay? So hope that's helpful. So let's just take a look here. Okay, so Joe Kamen says, I bought several NVDA August 30th expiration 100 strike calls 6 weeks ago. They are up approximately 140%. When will max volatility be seen? The night before earnings? Thank you. Yeah, That's exactly right. So implied volatility, so realized volatility, what the stock actually does, we're going to see that after they announce. But the price of the options in implied volatility terms will be highest right before the event comes out. So why don't we just take a quick peek at NVIDIA's behavior and see how these things have typically played out over time. So now we're dealing. Well, let's take a look first. Let's quickly see what their implied and historical moves are. So implying about 10%, average move 7.25. So let's take a look at, now these are very short dated options at this point, right? Just a week or so to go. So what I'm going to do here is I'm just going to say, okay, well, how did the front month options volatility behave, implied volatility? We're going to get rid of this historical one for just a second. And we'll go back for 8 quarters, so 2 years. And now I don't need to tell you when you look at this chart where the earnings events are, right? Because that's all of these big spikes. So these spikes that you're seeing are the quarterly results. And I'm going to see, is there a way I can, let's just bump the earnings in there. There you go. See? So all of these little dots represent earnings. I'm going to shut that ringer off. Don't need that. All of these represent earnings, and you can see how how the front month implied volatility spiked just before the event, and you can see how it plummeted when the event took place. So that's exactly what's going to happen to those August 30th options, by the way. And let's just take a quick peek at what the implied volatility of those is right now. So, a quick question I would have for you is, have you considered adjusting, because you had a bullish stance, have you considered adjusting to a higher strike, potentially? Because you've realized some good gains here. So the nice thing about your deep options is that they really don't have any extrinsic value to speak of. So the decay is de minimis. So the extrinsic value of the August 30th 100 strike options right now is just 40 cents. So there's essentially no decay in those things. That's the good news about the position you hold, right? The bad news about the position you hold is that it's going to behave essentially just like stock. And up and until the stock falls down to 100 or so, at which point you'll be better off than having owned the stock because you can only lose down to 100, whereas somebody who owns the stock could suffer a loss far greater. The issue I have, though, is that's a big move, right? You're talking about a move of, almost 25% of the current stock price for it to get down to 100. So the protective effect of having calls as a substitute for owning stock is diminished by that. So what you might consider, if you want to maintain that long position, I don't know how many of these things you own, but why don't we just pull it up here because it's easier to construct on Options Play, so we'll just do that real quick. And like I said, this is fine. A deep call option is an appropriate substitute for stock, especially at this point, right? It would be the functional equivalent of owning the stock and owning the August 30th 100 strike puts as protection. I'm just saying it doesn't offer a great deal of protection to own a put that expires in 9 days that is 25% out of the money, or thereabouts. Obviously if you had a huge drawdown, that could be something, but let's just take a look. So this is the option that you have now. We'll put this in on one side. August par calls, which are basically 100 delta, or they're very close, 96 delta according to this. So that's what you have there. And we can see that, your break even is going to be down here at roundabout, as you would expect, roundabout the strike price. And it's going to behave between 100 and anything higher than that, just like stock. And that's okay. But is it ideal? You know, to put things in perspective, we could say, all right, well, what if we'll just choose, I'll just go to the same expiration because I think it's, let's just say you had the 130 strike calls and you were short, well, these 160s, I don't know if that's a good one to pick, but we're expecting, options market expecting a 10% move on earnings. Well, let's just, you know, we'll be generous and call it, so that would take us to about 140, but let's make it 15%. So we'll take it up to 147-ish or something like that. Okay. And, you know, then you get a strategy that looks a little bit more like this. So first of all, you've had significant profits. So you could realize some of those profits, put a portion towards this strategy as an alternative. So if you own 10 of those calls, you don't need to go and buy 10 of these call spreads, but you could. We can see how much money you would be taking in, right? So each of these is, in round numbers, about $2,900. Each of those call spreads is, in round numbers, about 480. So, you know, you'd be taking quite a lot of money off the table, still have some upside. Now, you will have more decay. How much decay? Well, the 480, $4.80 a share. But, you know, maybe that's not a terrible thing. You know, we do see, we've seen some volatility in the markets, and we could get some here. Any kind of a disappointment. I mean, the AI trade isn't done. NVIDIA still occupies the preeminent position in their space. Nobody's really competing with them. It's all good. But yeah, just something to think about. So roll to the 140 calls. Okay. So yeah, I mean, you could roll to the 140s. Certainly if you wanted to preserve a lot of upside, you could do that. But there's going to be a decent amount of decay in those options. And actually, why don't we do this? Let's compare this to just doing the 140s outright and see what that looks like. So we'll just do a little side by side. Okay. So now these are going to cost $3, the 140s. And you know what? I could actually adjust to really make it like for like. How about we do this? I'm going to compare these two strategies, and I'm going to try to find two that are priced almost exactly the same. And then you can kind of decide for yourself which one feels like it's a better bet. So I'll go over here, and I'm going to modify this call spread. And I'm going to try to find a call spread that is closer to the 308 or whatever that you were going to spend there. So 135, 150, let's say. There we go. That's pretty close to a little over $3. So we're in the same ballpark now in terms of cost. Now, which trade do we like better? Well, this trade here, the call spread on the right, has an upside break even of 138.21, up $10, which is inside of the implied move. And this one has an upside break even of 143.08, which is up a little bit outside the implied move. And, you know, where are you going to end up getting ahead? Well, you're going to end up getting ahead owning the call outright if and as NVIDIA exceeds the higher strike of the call that you're selling in the call spread, which is 150. That's, you know, going to be quite a move, right? So we're talking about 9 days out from now. You would need to see this go up because you have a $5 lower strike. It would have to exceed 155 before trading the outright calls, the 140s, would be better than trading that call spread. Could it happen? Of course it could. But that's a big move, right? You know, 155, we're talking about a move of $28. so 20% higher. That's when the outright 140 calls become better than the call spread that I just outlined. So, something to think about. I personally would probably be more inclined to trade the call spread. But if you really think, we're due for a 30% move in the next 10 calendar days in NVIDIA, then maybe the outrights are a better play. In any case, the more important point, though, that I was making is that those 100 strike calls are effectively like stock. So, yeah, something to think about there. Okay, so I seem to remember somebody was asking about Pfizer and or Bristol Myers recently, and I'm not 100% sure I had addressed it. The reason I'm going to bring it up now and just wanted to take a look at it was because, my friend and CNBC colleague Carter Worth had indicated recently that he thought both of these might be situations that are bearish to bullish reversals. So, and they just stuck out because I seemed to recall that it was a topic that had come up. Where he makes that determination most often is that he tends to look at the 150-day moving average, which I'm highlighting here. And as he often likes to say, a moving average is essentially a self-drawing trend line. And we can kind of see what's going on. This thing has been in a pronounced and prolonged downtrend. In this case, we're looking at Bristol. Since 2022. And we can see that it sort of bounced through the 150 here briefly, and more definitively recently. It gapped through it, came back to the 150, and bounced off of it again. So I'm not going to play chartist, but before we continue on to the things that I like to look at a little bit more, which is fundamentals, we'll just take a look at some other technical indicators, and I will just, we'll let the machines do the work and see what those things have to say. So this, we can see it's about 50-50 right now, that in terms of the indications that are bullish versus bearish, it's about even between the two. But I would point out something that's interesting here, which is that more of the winning strategies over the course of the last year are bullish in Bristol Myers right now than losing ones. And of those that are bearish, more of those are losing over the last year than winning. This is particularly interesting because Bristol's been in a downtrend, right? So being long has not been a winning strategy, as evidenced by the buy and hold. So 1 year buy and hold, you're down almost 22%. Whereas some of these other strategies, like DMI, like just trading the simple moving average, the exponential moving average, the weighted move, all of these moving average numbers, all of these things are up anywhere from, call it 12% to as much as 61% over the last 52 weeks. So, be that as it may. How do I feel about it from a fundamental perspective? Well, I think most of you will know that I don't really get all that excited about stocks that are not growing at least as fast as the economy or inflation, whichever is greater. We hope that the economy is growing faster than inflation. Certainly, we hope that nominal GDP growth is positive. And this is not really a phenomenal growth story. However, we are forecast to see one of their better year-on-year revenue increases through the end of this year. The company does generate substantial free cash flow. It's not particularly cheap based on full-year EPS estimates, so it's not really expected to have a lot of net income this year. But if you look ahead to next year, assuming that the consensus view is right, because that's all this really is. So this is the amalgam of the all of the sell side that covers it. What is their consensus? What's the average adjusted earnings per share expected for Bristol for full year 2025? And their fiscal year lines up with the calendar year, so we're talking about fiscal year that ends December 31st, 2025. $7 a share. Well, it's trading about 6.5 times forward numbers. So that's pretty, if true, that's pretty compelling. Why don't we just quickly scan and take a look at who's covering this thing, and getting a sense of where those numbers come from. You can see that they are not overwhelmingly positive. You see a lot of holds in here, couple underweights and inlines. And one of the points that Carter made when he was talking about this, and by the way, if you're interested, he has a website called Worth Charting, and he provides daily updates and things like that. A lot of his customers, for what it's worth, he has an institutional following. He's had an institutional following for a long time. In fact, even before I knew Carter personally, we were clients of his back in my days at Ivory Capital, the hedge fund in Los Angeles. So I didn't know him at that time. That was 20 plus years ago. But we were clients of his going way back. And he was historically ranked one of the top technical analysts by Institutional Investor for many years in a row. They had kind of an all-star team that in Institutional Investor magazine used to keep track of. In any case, he offers a service. If you're interested in that kind of thing, you can go check it out. I have no financial incentive in that. I just know the guy, and I think a lot of his work, as many do. But it's not cheap. So let's throw that out there. He does have institutional clients, and they pay him institutional rates. So just something to think about. But one of the points that he had made about this is that you see these kinds of things and you're looking for these bearish to bullish reversals. Very often these are value traps. And I don't necessarily think of Bristol in this way. The other name he mentioned, Pfizer, I have definitely thought of in this way. So Pfizer is a company that I have not been that excited about. They had a huge run-up in revenues associated with the vaccines, and that has unsurprisingly given way. The rest of their pipeline has not been too extraordinary. They have not been as competitive on the obesity front. So, when you take a look at Lilly, for example, and you compare Lilly to Pfizer over the course of the last several years, it couldn't be more stark. Let's just in fact, I'll do that right now for you, so you can just take a peek. It's just absolutely stunning. Literally, these things are mirrors of each other, basically. And the reason for this is twofold. One, Pfizer had a huge run-up on the COVID vaccine business, which the vaccines turned out not to be as effective. Some might feel like they're not as necessary. I don't know. I'll let people judge for themselves. But, clearly that didn't turn into the recurring revenue stream that something like an effective obesity drug might. That's some pretty stellar outperformance, folks. 780% outperformance in 5 years. So, as for Pfizer, I'm not a huge fan. It's not quite as cheap as Bristol Myers either. So that's the other thing, is that 6.5 times earnings. It was Klarman who talked about a margin of safety. It's trading like a value trap stock, and there's definitely a huge difference of opinion between the $7 in adjusted EPS estimated for full year 2025 and the current stock price. I mean, those two do not reconcile with each other. So recognize that if you're interested in trying to play that thing for a bearish to bullish reversal, that this is you're trying to catch the falling knife. You're trying to catch it when it looks like it's slowed down or almost come to a complete stop. But I should say that you're looking at a stock that is valued like there's something wrong, and one of the things you might want to do if you're going to try to play this thing for a bounce or for some upside would be to do something like trade a call spread here, because there are clearly some fundamental underlying problems that shouldn't be ignored, or it wouldn't be trading like this, right? Okay. So looks like we have a related question. So this is on Novo Nordisk. So let's just take I'm going to compare this one to Lilly really quickly. Then we'll compare their multiples and just talk about that a little bit. Okay, so I'm going to go through the same exercise. We'll normalize this thing. And here, obviously, Novo is one of the participants in this story. And so Lilly's outperformance is far less pronounced. Remember that Lilly had outperformed Pfizer by 780%. It's outperformed Novo by about 350. What gives? So, a couple things to think about here. So one of the things we probably want to take a look at, and I'm going to just pull these up on separate. Actually, you know what? I can, rather than showing you these tables, so what I was going to show in table form, but there's a better way to do this. What I was going to show in table form is that the earnings growth for Lilly is much better. But actually, I think I have a better way to do this. I think I can chart both, which is what I'm going to do now. So we don't need to look at price. We don't need to look at this. I want to look at best EPS. Here we go. So I'm going to lose the price, and we're going to add Lilly to this. And basically what's going on here is that in recent history, the growth, and actually I'm not sure if this is that because it's not as easy for me to normalize this, but to put things in perspective, right? So let's just go back to September, or right here. This looks like a good spot. So if we just go back to June of last year, right? We've seen earnings double at Lilly year on year. This is last June versus the best forecast, which is now, in and around, we can see here, this is basically a doubling in earnings. Compare that instead to Novo Nordisk's earnings growth over the exact same period, right? So very impressive and far outpacing the broad market. And, they're in this great business. I mean, I've often joked that, is there a bigger business opportunity than obesity? It's a big opportunity, definitely in the United States and now elsewhere. But the fact is that in terms of what trickles down to the bottom line, their growth isn't quite the same. So, it's going to be obviously a function of the business opportunity. It's going to be a function of growth. That's why we look at things like PEG ratios, price earnings to growth, right? So if you're growing at 100%, you could have a PE of 100 and your PEG ratio is 1. And if you're growing at, and let's just do a little back of the napkin here, so around about the same, so that's $18 to, I'll even give them the benefit of the doubt. We'll call it 24, partially because it keeps the math easy. So you go from $18 to $24. It's a 33% increase in EPS. You get to a PEG ratio of 1 if you're trading at 33.3 times earnings, right? So faster growth, bigger multiple, better stock appreciation, and that's what we're seeing. So I think that that sort of tells the story. Can you look at Pfizer as well? Yeah. So well, I was just looking at Pfizer. So maybe you said that before I got. Oh, okay. Yeah. So yeah, I'm not super jazzed about Pfizer. Other than riding the vaccine wave, this has been dead money. I'm talking about both the stock and also the business for a very, very long time. And, I think about that every single time I'm in New York and I go to Grand Central Station because Pfizer's right there. I think, what is going on with that business? It's a tough business, right? I'm sure they, shouldn't be getting such a knock from me. Whose business is it of mine? I'm not in the pharmaceutical industry. But it does seem like others are doing a better job of it. And, I sometimes feel, it's like the Vince Lombardi quote, winning is a habit. Unfortunately, so is losing. And that's kind of Pfizer in my viewpoint. Right? Okay. So, oh, wow. I've already used up 45 minutes. There were some other questions, though, that we had gotten. I think one of them was on Nike, and I don't think we got a question on it, but I was thinking about Lulu recently. So anybody who's followed me for any length of time knows that for many, many years, and I still do, I've maintained something called the Holly Index. The Holly Index is so named. I originally got the idea when I happened to observe that if I looked at those consumer names that showed up on my American Express bill a lot, that those all proved to be pretty good companies to invest in. Now, at the time, Costco only took debit cards and Amex because they had an affinity relationship with American Express. We had 2 little kids. My wife was a stay-at-home mom, so she took care of the kids and she shopped a lot. And I got a sense for what was popular. And from that, I learned, number one, Costco, great investment, but she really liked Lululemon products, for example. And it proved to be a very good investment, and she was quite right about that. Lulu has not been so great lately. And I don't monitor the Holly Index quite the same way that I used to, in part because our kids are now older. And in fact, they both drove off to school today for their first day of school for this school year. And when they got to a point where they were more independent, my wife went back to work, so she doesn't spend as much money, and I don't actually get to see her credit card statements and sort of monitor my investment choices that way. But I did notice that she seemed to be buying less Lululemon stuff, and the boys were buying less Nike stuff, and so those names kind of got peeled off. Now, the reason I bring this up is because Lulu was a company that I always thought justified a reasonably high multiple. The interesting thing about it is it's not trading at a high multiple anymore. Right? So full year estimated earnings adjusted about $14 a share. It's trading at less than 20 times. So it's actually trading at a pretty meaningful discount to the S&P. And that's something it has not historically enjoyed. It has generally traded at a premium. So did Nike for a long time, which, by the way, also trades at a discount. Top line growth at Lulu didn't turn negative. In Nike's case, it did. So when I'm dealing with the kids and saying, do they just not care about Nike stuff as much? What's going on there? Is this trend in Uber-priced shoes and some of the other things that were so popular, is that falling off? Is it ON Holdings? You know, I've seen some of those shoes showing up around at the house. But the interesting thing about Lulu is that their top line is still growing. And growing, by the way, faster than the S&P. And yet it's trading at a discount to it. Appealed to a higher end consumer, which in theory should make them a little bit more immune. So these are all things that I happen to like about it. So I actually had a conversation, and actually yesterday being the day before the first day of school, there is a Lululemon store not far from where I am. Pretty busy outdoor, you know, it's most of the malls in California, it's often outdoors. There's a Vuori outlet, Vuori store at the same mall. Why do I bring this up? Because she has been purchasing more Vuori apparel lately than Lulu apparel. And I was very curious to know, is that a trend in Northern California, you know, where a lot of the women are wearing Lulu, best I can tell. Not that I can really tell the difference that well from a distance, but you know, that kind of apparel seems to be appealing. And companies that compete in that space, Athleta, which is a brand of Gap stores, Lululemon and Vuori. So I said, why do you buy stuff at Vuori rather than Lululemon? Do you still like Lululemon? What do you like? What don't you? And so on. So this was the feedback I received. Lululemon has better apparel choices than Vuori does. But her perception, at least, is that Vuori is higher quality. Something that was basically one of the strong points that Lululemon always had over Athleta. It was viewed to be very high quality. So where that's problematic to me is that it suggests that what is supporting Lulu sales and restricting Vuori sales is the number of SKUs that they have, rather than the customer appeal of the products that they sell. Still, the year-on-year growth forecasts are more modest for Lulu than they have been historically. We can see that we were getting mid to high 20s in terms of year-on-year adjusted EPS growth and even revenue growth, and all of those forecasts are dropping. So the only thing I can say about this is that right now the price action suggests that 11.6 billion in full year revenues for fiscal year 2026, which is really 2025 because their fiscal year ends at the end of January. So when I say fiscal 2026, that's basically February of next year to January of 2026. So just to put things in perspective. My guess is that those numbers are overstated, ambitious, that I think that people's estimates on Lulu are going to be coming down based on the comments that we're seeing. But I also feel that we've gotten down into, take a look, you know, at this price level that we've gotten down to here. See if I can draw a line. Oops. So this price level that we got down to recently was actually, you know, that was during the pandemic plunge kind of thing, right? So to me, do we think that it would be fair to be net long Lulu at the same sort of pre-pandemic price that it was? That's February 2020, which conveniently allows us to look at the fiscal year 2020 revenues, which, to put things in perspective, and I think this is kind of interesting. So February, so that's just pre-pandemic, the trailing 12-month revenues were 3.9 billion, okay? And for next year, 11.6 is the forecast, which I think is ambitious, and it might even be quite ambitious. But still, looks like there's a little bit of a margin of safety here. And it also looks like it's caught a little bit of a bounce. So I'm just going to offer it out there. You know, if you're willing to stretch, pardon the pun, maybe this is one to take a look at. One final point. You know, I'm going to just bring this up before I let you all go, because we're almost to the end here. Netflix. So I've been hearing people talking about Netflix, and some of my colleagues from CNBC talking about Netflix. I'm a little bit perplexed when people look at this thing and they're talking about some of the best performing stocks and talking about valuation. So this is really, it's a great growth story. Even despite the fact that the stock is up here. And look, a double top's a scary thing, and we're right in there. So we're going to take a look at that in a second. But take a look at the earnings growth for Netflix. And I think it's really quite extraordinary. I remember Priceline, later Booking, was another example of just really consistent. Let me see, where's my earnings per share here? Oops. I want to just show this. Earnings, is that what I want? No, I'll just go basic earnings per share. There we are. So let's just take a look at this. And I realize it's a crowded chart, so let me lose the price there. So we've got the PE ratio, that's down here, and we've got earnings in purple, and let's just blow this out a little bit so we can take a look at it over time. This is pretty remarkable earnings growth. And it's a little choppy, but it's pretty remarkable. And the way I described this to a friend of mine and a former colleague, my former boss from Ivory on Monday, was that, you know, Netflix seems to have pretty convincingly won the streaming wars. That's the first thing. And the second thing is it has become like a utility without having to get government approval on pricing. So essentially an unrestricted utility of sorts. How many people are really going to cancel their Netflix subscriptions? And what's the best substitute for it? Disney Plus? Paramount Plus, which is what, discontinued, I guess, or was going to be? Amazon Prime, maybe? It's tough. It is tough to find a suitable substitute for Netflix. How many people who have Netflix, imagine if Starbucks increased their prices by 30% tomorrow. How many people would walk in, see that price at the register, and not come back the following day? A good percentage. And what we're talking about is price elasticity. If Netflix increased their prices by that amount, how many people would actually cancel? I mean, it's a pretty cheap service. So I'm not going to say, and look, I get it. I know why a lot of folks, and I'm going to show it right here now. Oh, look at that. The line, I don't even know why the line is already drawn in there. I was probably looking at this yesterday and it saved the chart I was working on. There we are. So, you know, that's the double top situation, right? So that's the reason to be concerned about it. High flyer, had a huge run, right up here against this double top. But I just want to offer to anybody who's a long-term holder, before you head for the exits, you know, ask yourself those fundamental questions. Could we chop around in here, or even just, you know, fail at this level? I suppose. We haven't gone convincingly enough through it yet. But, you know, their underlying business, to me, remains intact. So, you know, everybody wants to say things are overvalued, this is too expensive, that's too expensive. But some things are expensive for a reason and should be. Some things are inexpensive and we're not sure, like Lulu. Some things are inexpensive and we have seen why they've been floundering around, like Bristol Myers, but have gotten so cheap that maybe it's worth a flyer. So those are just three names that one speculative, catch the falling knife on the long side, one less speculative, and one where their fundamentals continue to remain intact. And it's obviously expensive if you look at it on a trailing basis to the S&P, but it should be. It's growing much faster. That's this one. So thank you very much for squandering an hour to listen to me ramble on. I should have, that should be our theme song. Can we get the Allman Brothers in here? Ramblin' Man? Yeah, I'll get copyright strikes. I'm sure buying the rights to it would not be inexpensive. But I appreciate all of you tuning in as you have done, and obviously for interacting. Ask questions, happy to try to get to those, and bang some in there, and I will try to get to them on the next live stream, which we're scheduled to hold at 4:15. I am probably going to be doing a market talks on NASDAQ with Jill Malandrino, who I did some work with her and Jim Cramer when they were both at thestreet.com many years ago. But we'll try to get one of these intraday live streams going too. And if you have the notification bell turned on, you're going to know when that happens. Thanks for watching.